Hello, everybody. Thank you for joining. Thank you to the mods in the chat and Sir Winston and everybody else. There is a palpable sense of concern out there in the community, and a lot of people want to know, is the AI wealth window closing? The impact of AI has been quite profound since 2022. And now I can tell by the temperature of the room, a lot of people are asking very interesting questions like, what's happening? Is there a job apocalypse? We just saw the SaaS apocalypse. Is the ultimate wealth window about to shut? Where can we invest? How can we borrow against our assets, etc.? How can we secure financial freedom? Well, we'll break down a whole bunch of stuff today, including zombie companies, proxies, synthetic dividends, STRC, Bitcoin, Solana, AI. So grab your coffee. Let's dive in. And a big thank you once again to all the great mods in the chat and everybody else for coming. Let's get into it. Not financial advice, of course, just a guy on the internet, as you know. And all the questions come from Patreon. Literally every week, the temperature changes. And I will hopefully represent, in the team that chose the questions, a way of reflecting the concerns that people have today. First question. I'm going to turn off my camera just in case people want to read it, but I won't bore you with the details. But this is from the original Regray Ghost, I think. And they used Grok to find the top 0.3% growth stocks for the next 5 years. And this is great because that means you watch my videos and you know the importance of being in the top 0.3% of assets, not the top 1%, not the top 3%, but the top 0.3%. So Regray Ghost got it. Now, he used Grok to find a whole bunch of names that could be in the top 0.3%. And it came up with a company called ANET. And we're going to analyze it real quick. ANET is Arista Networks. And as you know, I do have a thing called the IA9, which became the IA13. I found all these in June 2025. Can't believe it's nearly a year ago. But we're going to talk about them as well. First of all, ANET has stunning financials. They have demonstrated massive, consistent growth in revenue, EBITDA, from 2014 all the way up, and their cash is unbelievable, and they have no debt, and they're profitable. This one is a gem. A lot of people, they identify stocks and say, ooh, great. Well, Grok did a good job identifying this, but there's a couple of things. So big part of my IA13 is data center growth. It's a huge narrative, and there's a ton of money to be made. But when you break down the different companies, there's a few that play in the same field. And one of the things I looked for is very high concentration of AI exposure. And ALAB is basically 100% AI exposure, 100% focused. Marvel is a value play, also very heavy AI exposure, whereas ANET is about 60% AI because they do work with traditional data centers as well. And looking at the AI network connectivity, ANET wins on quality and proven execution, yes. But for comparison, ALAB, again, much higher concentration. And it's all about kind of optics, optical connection, network switches, all that type of stuff. Now, let's look at the chart for ANET. It is very good. Very nice chart. This is on the ATR model. And you can see very clearly here, it's breaking out right now. The trend is very strong. No sell signal. And the area where I would like to buy would be about $140. That would be the nibble layer. I don't chase stocks, but 140 would be level 5, the new level 5 on the ATR model. If anything did happen, we got a little gray swan, black swan, talk of an AI bubble. Boom! You go snap some of this up at this price. But I do not chase. I replace. Very important. Now, I did look at ANET back in May and June of 2025, and I chose other names instead. I chose Marvel and Astera Labs instead of ANET. It's kind of funny, all the A's. But when you look at the actual returns, if again, there's a couple of things here. You can't own them all first of all, and how it compared in performance. You can see I chose faster horses. ANET, yes, it was on my list. It didn't qualify in the top 9 originally, and you can't buy them all. Marvel, though, in the same time frame, was up 170%. ALAB up 125%, and ANET just up 85%. You could say it's lagging, but it's also a very, very good company. But again, what I try and do is excise the 0.3% and then some. Again, a lot of companies will benefit from this revolution. Is the window of opportunity closing? Well, these names have been on a complete rampage. And that's what a lot of people are concerned about. How can things just go straight up? Like AMD and Marvel and all these great names. We'll see when it runs out of steam. But for now, I'm enjoying the ride. And who knows, it could continue through 2030. But we'll watch for the trend to turn. The first sign of a slowdown or some type of apocalypse happening in this AI data center build out, you'll be the first to know. Thank you for the question. Next question is from Bob33. He is about to hit his 300 share retire on bag for Tesla and asks if he should be dedicating all resources to building a 400 Solana bag or pile into the top 4 AI picks before the AI job apocalypse window closes. This is a very short question, but there's an awful lot to this that I'll try and break down and tackle. And, the world is changing. We're going to see 100 years of change happen in 10 years, maybe less, maybe just 5 years. It is radical. Thank you, B-Man, as well, for coming. First of all, you referred to the AI job apocalypse. Well, AI automation will likely displace at least 20 to 40% of white-collar jobs by 2030. And that creates a narrow, high-return window for AI infrastructure stocks, because the AI infrastructure is kind of the picks and shovels to build the AI that will do the displacement. So I hope you can see the kind of timeline I'm trying to build here in my mind. I should have added a graphic. And yes, this is doomy and gloomy, but it's important to realize, and you can't say you're surprised because I've been talking about this since very late 2022. And here we are. And also the returns. This is kind of very concerning. This is from Kobesi. And this chart is data from Goldman Sachs. And it shows the AI infra returns, specifically, again, those picks and shovels, index returns, and how they've completely smashed mega cap hyperscalers, S&P 500, etc. Software got destroyed. So we're already seeing apocalyptic type stuff happening because of AI. And the money is rotating, and you have to be part of that rotation. Again, don't chase, but last year was the year to start getting exposure. Anyway, moving on. The key to building a bag too is not just saying you're going to build a bag. Yes, you're supposed to have a plan, but you're also supposed to wait. You need to be able to look at a whole bunch of different things. Imagine the IA13 portfolios, 13 names. What I do is I set my layers and traps, compare that to my 2030 valuations, and then determine, okay, I have all my spider webs out. What is going to fall into my trap? I let the market decide. Build my layers, set my alerts, and let the market determine what I buy. So, for example, it took me 10 months to build my IA9 bag. Absolute patience. And that's what you need to do as well. Don't say, oh, now I'm just going to buy Solana, although Solana is very cheap right now. So it would definitely be in a trap. Solana at $80 is probably a very good deal. Now, what you could do, though, is look at a couple of things and beware of this. Crypto is extremely risky. I can't stress that enough. Solana runs 44% of all transactions on crypto. 44%. But nobody gives a shit about it, okay? That's the problem. Nobody knows how to value it or appraise it. It's trading at 17% or 18% of the Ethereum market cap, and it does infinitely more than Ethereum. So again, people can't even appraise stuff that runs at 15 transactions per second. It's ridiculous. And that's why it's frustrating, and it could stay here forever. But when you look at the experts, the projections, this is very important. The base case for compound annual growth rate for Solana through 2030 is 25 to 40%. The bull case is 40 to 80%. That would take us to $2,000, $3,000 a token if things take off, or if the market knows how to appraise it. Now, compare that to the IAI basket. The CAGR for that is 23 to 30%. And that's the big difference. So remember, crypto is very risky. It could all go to zero. There could be somebody in the basement building a new Solana. We don't know. That's the problem with investing. You got to take your risk, got to find your things early, build a position, and sit and wait. Okay. So here, my recommendation, not financial advice. You could allocate 65 to 75% of your new capital to the top 4 AI stocks over the next 18 to 24 months. Wait for them to fall into your traps. Do not chase. Wait for them to mean revert. And use the remaining 25 to 35% of DCA into Solana on dips. Again, sub $80 price is great. And then after, remember the big rotation too, because AI may not go up forever, or the picks and shovels. That window may close soon. And once AI appreciates, so you start making 40 to 50, 100% on your positions. Like look at Marvel, it's up like 128% in a couple of months. Then you should maybe take a little off the top and rotate it into your Solana and build your 400 bag. So that's your game plan to think about, or whatever assets you like. Just an idea. Next question is from iRock. You keep saying 60% of the S&P 500 will be zombie companies by 2030. And iRock asks if they should sell their S&P index fund and take a chance on the IA13 names or crypto, or if the index will keep trading higher. So first of all, iRock, I'm disappointed you still hold a S&P 500 index fund. Okay. You've heard me, and I know you've been in the community for a long time because I refer to you as 007, like James Bond. So that's surprising. And yeah, 10% CAGR, who gives, or 11% or 12%? That's not good enough. And per the chart I shared earlier, was it slide number 11? Just ta-da! That's what the the IA13 did. And S&P 500, nothing. So anyway, it's important. Let me explain the reasons why I believe 60% of the S&P 500 will be zombie, and why things change very slowly. First of all, 6% of the S&P 500 companies are unprofitable. A ton of them have no growth. 42% of the Russell 2000 companies are unprofitable. That's nearly half. And 22 of the S&P 500 stocks have had negative returns over the last 10 years. And you've seen all my analysis of stocks over time as well. We'll get more into that in a second. So first of all, this is before the big change is about to hit. Now, SAASPocalypse. This is a cool website out there where you can actually profile a company or yourself if you're looking vulnerable. This is a company called DocuSign, which dropped 71.3% after saying they spent 20 years convincing the world that typing your name in cursive font is worth $50 a month per user. Again, there's so many companies out there that are ripe for absolute disruption. And these are technology companies. Can you imagine all the other companies? Now, if you're in the business of changing tires on cars, you're going to be fine, okay? Because robots aren't going to do that anytime soon that I know of. And those types of businesses are fine. But other things are definitely going to be massively disrupted. In 3 months, we'll be able to one-shot anything. Anything. One shot means create a brand new Google Chrome, for example, that costs $10 billion to build over 10, 20 years. Now you'll be able to do it in hours. That's what's coming. Okay, not to be an alarmist, but to set expectations. Now, I mentioned this before, all the gains, boom. Now, back to your 11%, your 10% return on the S&P 500 index fund. As Saifedean have used this slide so many times over the last 4 years. Again, inflation. And not all things inflate at the same time. If you are in the business of buying LCD TVs, they go down in price. But the average fiat on the planet experiences a dilution of 14%. That means every year humanity loses 3.5% of global wealth, roughly 14 trillion, to finance government parasites, fraudsters, and monopoly gangsters. Banksters too. All the gangsters. And we just uncovered how much fraud there is in government. In fact, California, where I'm sitting right now, they're trying to make it illegal to uncover fraud. You can't make this stuff up. This is the bonkers Orwellian crazy world we live in. Government, if a government employee steals from taxpayers, they should be locked up for 20 years minimum. And I mean that with absolute conviction. The hammer needs to drop on these fraudsters, all of them. Anyway, back to stocks. Get off my little soapbox. And I've shared this analysis from my video last year many times. 1926 to 2024, to be in the top 0.3% of stocks, you've got to be, because that's where all the returns are made. Okay. You make all of the returns pretty much in the top 0% of 0.3% of stocks, not the top 3%. And the bottom 97%, you lose money on. Okay. Debased to death. And remember, why I believe 60% of the S&P 500 is a zombie is because of the AI disruption that's coming. And 51.6% of US stocks from 1926 to 24 delivered negative lifetime returns with a median return of minus 7.4%. Absolutely, you get cooked, and that's before debasement. So it's just shockingly bad out there. So if you believe you're safe in an index fund, yeah, the winners will carry the fund, but you're better off being in the winners directly, not sharing your bag with 497 other non-performing companies. Hope that helps. Tbrogan. And also don't rush into the I-13. Wait for layers like we discussed that before. Next question is from Tbrogan. It's a bag building question. And Tbrogan asks if they should focus on reaching a specific goal like 300 Tesla shares first, or hit a 50% portfolio allocation, then shift allocating to the next asset, even if the share target isn't met yet. This is very important as well. So it depends on who you are and your risk profile. I always talk about the goal of having one Bitcoin. I made a detailed video on Friday regarding how whole coinership has tanked dramatically from about 350,000 whole coiners when I did it 2 years ago to about 224,000 today. Again, 224,000 people have a pure form whole coin now. Absolutely stunning. So you can think about that rarefied air if you can have such a position. And then 300 Tesla shares. I'm saying that now for nearly 5 years, why that's important. So first of all, AI is the faster horse. And I mean of anything, but you got to pick the winners, just like before. Tesla is the top AI AGI name of the planet, and layer in SpaceX. Crazy. Now, don't trust me. Forget me. I'm just a guy on the internet who likes sharing information. But Peter Diamandis came out and tweeted this on Friday. And this is why I am very bullish on Tesla. But he is much more eloquent than I am. Shout out to Peter. Peter points out that Elon Musk just announced 2 chip factories in Austin, one for Optimus robots, one for data centers in space. I'll repeat that. One for Optimus robots, humanoid robots, and one for data centers in space. Name another human, any human on the planet, building chips, cars, self-driving cars, autonomous cars, robots, rockets, and AI simultaneously. Name one. There is nobody. Now, another view of this world. Turn off the camera again. Like literally, this guy is touching everything. This is the Muskonomy, and whoever created this graphic, I've seen different versions, but it's really good. And it's pretty. And he's at the center of everything. And just to read a couple of points here, you've got SpaceX is how we leave Earth. Neuralink is how we think. XAI is how AI evolves. X is global communication. Robotaxi is the future transport. Boring Company is connecting cities and how cities move. Starlink is how we connect on the planet. And Tesla is how we move. All of this, one guy. And this is before all the chip stuff as well. The synergy between these companies is off the hook. Now, the TAMs are also off the hook, the total addressable markets. The first thing I do when I go for a market is to identify how big the market is. And when you look at these TAMs, SpaceX just came in at a massive 28.5 trillion. That's in their S1 filing for the SpaceX IPO. The rest, you add them all up together, AI, agents, humanoid robots, energy storage, robotaxis, you get $83.5 trillion of total addressable market. Again, find me a company that's tackling all of these at the same time. And yes, I know people are pissed off that Tesla isn't on the moon like all the other names. It will get there. It's picks and shovels first, AI, AGI second when the world wakes up. And I've never been more sure about anything else in my life. 36 years of analyzing stocks. Boom. Now, back to 300 shares. Why 300 shares? Well, if we go to our retire on model here, 300 shares is projected to reach conservatively an opening balance of about 1.24 million by 2035, but probably in reality an awful lot higher. And this is assuming a very, very conservative CAGR. You need to look at TAMS, you need to look at CAGRs, you need to look at moats, you need to look at all that stuff. That's how you determine what you invest in. It's not hard, my friends. That's the power of this. Now, back to your question. Sorry for being so long-winded. I have to paint the picture, the tapestry. My recommendation is, yes, prioritize hitting the 300 share goal first. And if you have greater than 70% conviction in the Tesla thesis, like I do, you're good. Once you hit 300 shares, shift the new capital to your next bags like AI, Bitcoin, Sol, etc., using percentage allocations as a dynamic guideline. And I share my allocations every single week, exactly how I play the game. And I am obsessed with finding winners and obsessed with optimal allocations and obsessed with layers and hedging, etc., etc. That's the game. It's not hard, folks. Next one is from CryptoChristian. Interesting one. This is I really like this question. Christian asks about selling assets in retirement versus using margin against them. They wonder if we should avoid selling assets appreciating at a 20% CAGR unless the margin rate is higher than the CAGR. Yeah. So fun fact. I had to blow all my cash to pay my taxes. And I had to borrow money to pay my taxes. Did I sell my assets? No. That's anyway, you never go broke paying taxes. But the pain of selling assets at this time is really hard, really high. So let's talk about what you're talking about. And I'm going to lay it out in real simple terms. Let's talk about CAGRs. CAGRs again. When looking at the CAGR versus cost math, you must weigh all the variables. Make sure you're in a winning asset. You're making at least 18% per year on average CAGR over like a 5 or 10 year period. Okay, that's in the 0.3% of stocks that do that. Yes, there will be down years, but don't get shaken out. And then make sure you secure a low cost margin, 4.5% to 6.1%. Low 4.5% is very common in brokerage accounts. And look at your capital gains tax of long-term capital gains, like 20%, 15%, wherever you are in the world. I'm not a tax accountant, but check that out as well. That will determine what you do. Now, remember, the math is so simple. Write this down, everybody. This is so important. And we'll do a lot more on borrowing against your assets and optimal ways to do things. This is the break-even rule. When to never sell. If your CAGR is greater than your margin rate plus the tax drag, you never sell. Very simple formula. CAGR, say 18%, margin rate, say 5%, tax drag 20%. Yeah, you might be underwater. But if your CAGR is higher than those, you're golden. So that's the math homework for you to decide on. And remember the synthetic dividend. Instead of the 4% rule of selling assets, and paying tax on them, borrow 4% of your portfolio annually against a low-cost margin. And that historically extends the longevity of your portfolio by 15 to 25 years. If you can increase, and I made a detailed post on Patreon yesterday regarding NVIDIA and what it's done over 25 years, how a small amount like $10,000 goes to 2.3 million. And it's not uncommon. But the thing is, you need to hold the assets as long as possible. So yes, borrowing against them is what the rich people do. They write off the interest because it's tax deductible in many places. And that's the life hack for you all to know. Thank you for the question. Mybizz, I think that means mind your business. I like it. I like that name, mind your business. It's a question from Mybizz asks why SATS, which is EchoStar, is a better instrument for SpaceX over the ETF XOVR, since SpaceX makes up a big majority share of the fund. Let's break this down. And yes, I've been clamoring over SpaceX exposure for quite some time, and it's important to have before the IPO. Remember, before the IPO last week, I broke down how you play the proxies post IPO. Check that out last week if you want. But let's dig into it. First of all, XOVR. I call it XOVR, XOVR. Sounds very interesting. They have a combination of things in their portfolio. They got pre-IPO stocks like SpaceX and Anduril. And I saw Anduril and I got very excited. I'm very excited. It's like, wow, this is cool. But hold on. When you dig into their portfolio, Anduril is only 0.33%. And again, it's within an SPV. We'll get to SPV as well in a minute. So they advertise on their webpage. They advertise to get people to get FOMO like me. Anduril. Everybody wants Anduril. It was kind of shady, and they've got basically non-existent allocation to it. So let's talk about special. And when you see words like special and SPAC and safe and all that stuff, they are very dangerous words. Be very careful. Special purpose vehicle smells like SPAC. And the SPV exposure to SpaceX LLC does make up 24.94% of the fund. But the SPV only gives the ETF indirect exposure to SpaceX. The ETF does not own SpaceX shares directly. So you got added layers of risk and complexity here. Very dangerous. Also, I got to turn off the camera again. I can put myself top left so you can see me. Head-to-head instrument analysis. Let's have a look at this. EchoStar is a liquid public stock. It has, you could argue, indirect ecosystem exposure, but it does own 2.8% of SpaceX, which is huge. So for a long time there, you could actually buy EchoStar for less than the value of their 2.8% share of SpaceX. And that was under a $1.75 trillion valuation. And it's going to IPO above $2 trillion. Very important as well. So it's a liquid stock. It's pretty steady Eddie. And that in itself is a better ARB play than buying XOVR. Okay, because the SPV market's very opaque, make me very nervous. Special things, private public crossover. I don't know. I just don't like it. So the Quant Verdict, liquidity and transparency, excellent for SATS. That's the winner. SpaceX direct exposure. XOVR has a higher concentration. You could argue 25 to 40% via SPV. But SpaceX owns 2.8%, which oftentimes is more than the market cap of EchoStar itself. So that is actually a better exposure, in my humble opinion. And the Sharpe ratio, better with EchoStar. So from my perspective, EchoStar is the winner here. Next one is from Mr. Garlic. This is a lot of questions regarding STRC. Mr. Garlic asks about STRC. Once Bitcoin achieves widespread full adoption, will STRC lose its edge as an efficient way for strategy to raise low-cost capital for Bitcoin accumulation? They ask for the expected time horizon for this model. Let's look into a couple of things. And first of all, Phong Li, who is the CEO of MicroStrategy, he just said, Stretch will disrupt the $150 trillion fixed income market. Every boomer millionaire is only making 3% return. Now they can get 11%, 11.5% annually with Bitcoin. This is not priced in. And looking at how much, and I know Saylor's going to buy again tomorrow. He'll announce his buy in the morning. The demand for this thing is off the hook. I mean, you can create a 60-40 bond portfolio with less than 10% allocation to STRC, and you can keep your 90% in disruption stocks and make an absolute fortune. So if this continues, that's the question though as well. And I know all the non-believers in Michael Saylor and the haters are out there making videos like, oh, it's a Ponzi and everything else. That always happens. But I've been in MicroStrategy since September 2020. I was the first one in it. My third ever video was about it, and with an option trade. Now here we are, and the FUD storm is every day. It always continues. But why does the model work? It's because the math works. STRC raises capital at approximately 11.5% cost. Yes, it's expensive, and it deploys into Bitcoin without dilution or maturity wall. And the break even is simple. As long as Bitcoin returns greater than, say, 11.5% per year, it works. And in fact, because it's such a small concentration of their actual portfolio today, Bitcoin only needs to return 2.2% for it to work. But over time, as you mentioned, Mr.Garlic, Knoblauch, that could change. And we're going to break down the actual timeframes now to get a better feel. Short term, 2.5% will keep it afloat. Long term, it could require that 11.5% CAGR to make it work. Now, the runway, how long we have, a lot of people believe Bitcoin will go to, $1 million by 2030, 2035. People like Cathie Wood, ARK, etc. And Bitcoin adoption is still less than 10% globally. Look at the amount of Holecoiners from my video on Friday. It will alarm you. And the market cap needs to 6 to 10x to reach the mature asset status. So we need to go up to $500,000 Bitcoin for it to be a mature asset. So in the meantime, STRC has a lot of runway to go as long as the CAGR stays above that key level. Again, once the STRC becomes a larger bucket of the market cap of MicroStrategy, then they need to see a Bitcoin CAGR of above. But by the way, Saylor himself can single-handedly keep the price of Bitcoin up. Just him. Forget the ETFs. Forget Morgan Stanley coming in. Forget Goldman Sachs coming in. All these guys. Just Fidelity. Just Saylor can keep the price up. He can prevent a bear market or take us out of the bear market. And so watch this space carefully. And what I do believe, though, is this thing will run out of steam by 2030. We'll see. As Bitcoin matures, the returns will compress, probably down to 8% or less for STRC. But we need to see exactly what Bitcoin does. Now, if we do hit that supply crunch between now and 2030, everybody wins. We go to the moon. Okay, this is the fascinating thing about Bitcoin. If people are still buying it and there's none available for sale, we'll see the craziest price discovery ever in the history of the world. And that's why I am in it. And that's why I'm excited. I know it's going to hit. I just don't know when. Enjoy the ride. And here, my projections of the CAGRs again. CAGR. That's all you hear about. STRC, maybe a 10 to 12% CAGR, 2026 to 2030. Might fall as low as 8%. We shall see. Direct Bitcoin should get you 20 to 40% CAGR, depending on who you talk to. And MicroStrategy common stock should be a multiple of that, 30 to 60%. That's why I still own MicroStrategy and weathered many storms. A little rotation, but that's my game. And this week, we're helping Sea Shepherd, helping animals. We donate to Sea Shepherd to help them support their mission to save entangled sea lions, which is awful. The fisher nets are terrible out there. I'm going to do some live questions now, but I hope you all learned something great today. That was the AI Wealth window closing. And let's do some live questions. And a big thank you as well to the team behind me, because I make them work on Sundays. They hate me for it, but that's okay. Well, never sell your assets. Yikes. That term, by the way, the term never sell your assets. Of course, you sell your assets at tops and you rotate and you get into narratives before they actually hit. I want that to be very clear. And a big thank you is all for your super sticker. Sir Winston, B-Man, Signal 103, and Piper. And we have people in Chicago, etc. I hope everything was clear. It looks like there are no no real questions. Yeah, and I do want to say one thing regarding MicroStrategy and STRC and Bitcoin, just to stress again, everything can go to zero. Bitcoin can go to zero. Sol can go to zero. Tesla can go to zero. That's the danger of investing. That's why you need to allocate accordingly and ride it while it's still a fast horse as well. No DCA tomorrow. No, correct. Thank you all for coming. Have a great day. Bye.